The structure decision can kill a raise before it starts. Most seasoned developers spend months preparing their deal before they ever think about the structure they're going to use to raise it. This is usually a mistake. Family offices in 2026 are not just evaluating your project, they're evaluating whether the vehicle you brought to the table matches the level of trust that you have actually earned. And getting that wrong does not just slow a raise down, it can stop it entirely even when the underlying deal is solid. This video is the next step after deciding which type of family office to target. If you've already worked through how to choose between a single family office and a multi-family office for your LP equity raise, the question you now need to answer is, what structure should you bring to that family office once you get the meeting? The answer matters more than most developers expect. Family offices have quietly shifted how they deploy capital into real estate, and the structure you present is one of the first things they use to screen whether you understand how they think. And here's what this video will show you: why family offices are moving back toward deal-by-deal structures here in 2026, and what's driving that shift. What each structure actually demands from you as the developer in terms of track record, reporting, and LP expectations. A practical decision framework that you can use to choose the right vehicle before outreach begins. The core argument is simple. For most $10 million plus raises targeting family offices right now, deal by deal is easier to place. Blind pools are not impossible, but they require more proof than most developers realize before the first meeting. Why family offices are leaning back towards deal by deal in 2026. This is not a new preference. Family offices have always valued control and visibility, but several years of weaker fund performance, longer hold periods, and opaque underwriting pushed many of them to pull back from blind pool commitments and closer to the asset itself. That shift has accelerated in 2026. According to PwC's Global Family Office Deal Study 2024, family office investments in funds declined by 9 percentage points since the end of 2020, and at the same time, club deals where investors participate alongside others in a specific transaction held steady at 60% of family office investments by volume. Now, that combination tells you something important. Family offices did not stop investing. They changed what they were willing to invest in and how they wanted to structure their involvement. The GenCom example is the clearest live signal available. In February 2026, GenCom's CIO disclosed that family offices had historically made up about 20% of the firm's capital pool. On recent deals, that figure exceeded 50%, with the most recent transactions almost entirely funded by wealthy families. The reason cited was direct. Family offices want better economics, more governance control, and a direct relationship with the operating sponsor. A blind pool structure eliminates most of those. What family offices want: asset level visibility before committing. Deal by deal delivers full underwriting on one specific deal. Blind pools require trust in the GP's future asset selection, governance rights, and decision input. Deal by deal delivers approval rights built into the JV or co-invest structure. Blind pools require delegated discretion to the fund manager, direct sponsor relationship. Deal by deal delivers one-on-one accountability to the LP. Blind pools mediate the relationship through fund documents. Downside clarity. Deal by deal delivers a specific business plan, exit strategy, and loss scenarios per exit. Blind pools spread portfolio level risk across unknown future deals. Flexible participation. Deal by deal gives you the option to pass on future deals. Blind pools lock capital in for fund life. The underlying shift is about what happens when things go wrong, not when things go right. Family offices and passive investors are retrenching back to deal-specific deals, especially if it's a unique deal that truly can stand on its own versus allocating into blind pool funds. The first question from a family office is no longer what's the projected return, it's what happens if the deal slips, costs rise, or exit timing changes, and how does that structure protect me as the investor? The real insight: deal by deal structures do not just give investors visibility, they give investors accountability. And in 2026, accountability is what moves capital. Deal by deal versus blind pool. What changes for the developer? Understanding why family offices prefer deal by deal is only half the picture. The other half is understanding what each structure actually demands from you as the sponsor. Most developers underestimate how much more institutional a blind pool pitch has to feel from day one. The differences are not just legal, they show up in how you prepare, what you need to prove, and how long each stage of the process takes. Key principle: the more discretion you ask for, the more proof you need before outreach begins. A deal-by-deal raise asks investors to trust your judgment on one asset. A blind pool asks them to trust your judgment on every asset you will ever buy inside the fund. Diligence scope: in deal by deal, the investor underwrites one specific asset, business plan, and the exit scenario. In a blind pool, the investor underwrites the GP's track record, scoring process, and future deal selection ability. Governance: in deal by deal, LP approval rights, co-invest protections, and asset-specific reporting are built into JV documents. In a blind pool, discretion is delegated to the GP within fund parameters. LP rights are more limited. Reporting standard: deal by deal requires asset-level updates, construction progress, leasing, cost variances, exit timeline. Blind pools require portfolio-level reporting plus capital call notices, NAV updates, and fund-level metrics. Speed to first close: deal by deal is faster because the investor can underwrite a known asset. Blind pools are slower because the investor must evaluate the full fund thesis and team before committing. Sponsor burden: deal by deal means preparing deal-specific materials, investment memo, pro forma, sponsor co-invest, waterfall. Blind pool means preparing platform materials, track record, PPM, fund strategy, sourcing engine, team depth. Investor control: high in deal by deal with deal-specific approval and exit rights. Low to moderate in blind pools depending on fund documents. Repeat capital path: in deal by deal, you build trust one deal at a time, and the LP can choose to participate in future deals. In a blind pool, capital is committed for fund life, and the LP cannot selectively participate. What this means for your materials: a deal by deal raise requires a tight investment memo, a clear business plan for the specific asset, a well-structured waterfall, and evidence that you have done this type of project before. Investors are underwriting one deal. Make that deal easy to underwrite. A blind pool raise requires something much closer to an institutional fund pitch. You need a polished private placement memorandum, a detailed track record across multiple projects, a documented sourcing and an underwriting process, and a team that looks like it can execute a pipeline, not just one project. The most common mistake is showing up with a fund pitch that looks like a deal pitch with a different cover page. When deal by deal is the better structure. For most seasoned developers, raising $10 million or more from family offices in 2026, deal by deal is the right default. Now, here are 5 clear signals that it's the better fit for your raise. Number 1, you're raising around a specific defined asset or a project. If you have a ground-up multifamily site under contract, a value-add industrial acquisition under LOI, or a mixed-use development with a clear business plan, deal by deal is the natural structure. The investor can underwrite exactly what you're building, what it will cost, and how you plan to exit. That specificity reduces friction and shortens diligence. Number 2, you're building new family office relationships, not deepening existing ones. Family offices that do not know you yet are unlikely to commit blind discretion on a first engagement. Deal by deal gives them a lower risk entry point. They can evaluate you on one transaction, and if it goes well, they will consider future deals. This is how most institutional LP relationships actually start. Now, number 3, your track record is strong enough to get meetings, but not yet deep enough to justify a fund. 3 to 5 completed projects with good outcomes is enough to generate credibility in a deal-by-deal pitch. It's rarely enough to anchor a blind pool raise, where family offices want to see a documented sourcing machine and evidence of repeatable discipline across many cycles. Number 4, the family office you are targeting wants approval rights or co-invest economics. Many family offices, especially single-family offices with active investment committees, want to say yes or no to each deal. They do not want to commit capital to a fund and then receive capital call notices for assets they never approved. Deal-by-deal structures accommodate that preference. Blind pools do not. Number 5, you want to preserve optionality on future deal terms. Each deal-by-deal transaction is negotiated on its own terms. The waterfall, the preferred return, and promote can be adjusted based on the asset type, risk profile, and LP relationship. A blind pool locks in fund economics across all assets for the fund's life. For developers still refining their LP relationships and deal mix, that flexibility has real value. Bottom line, family offices still favor smaller deals under $25 million with growing but selective interest in larger checks. Deal-by-deal structures match that preference almost perfectly because the investor controls how much they deploy and on which assets. When a blind pool can still work with family offices, blind pools are not dead with family offices, but the bar to get one placed is much higher than it was 5 years ago, and many developers who think they are ready for a fund are not. The honest question to ask yourself before pursuing a blind pool is, have I built the machine, or do I just have a deal list? Use this checklist to pressure test your readiness, your track record. You've got completed 5 or more projects of the same type you plan to acquire inside the fund. You have realized exits, not just unrealized projections to show your LPs. Your returns are documented, auditable, and consistent across cycles, not just on your best deals. Pipeline and sourcing, you have a documented sourcing process, not just a network of brokers. You have a repeatable acquisition or development strategy that does not depend on finding the perfect one-off deal. You can show a pipeline of future opportunities that fits the fund's stated criteria. Reporting and operations. You have institutional-grade quarterly reporting in place from prior deals or funds. Your team can manage investor communications, capital calls, and NAV reporting without adding significant headcount. You have legal infrastructure for fund administration, including a PPM and fund counsel. Investor relationships. You have at least one anchor LP who knows your work and is willing to commit early. You have prior positive history with at least some of the family offices you plan to target. Your existing LP relationships are strong enough to support a multi-year capital lockup. Alignment. Your fee structure is defensible against the question, why should I pay a management fee when I can access your deals directly? Your promote is structured to align incentives, not front-load fees before performance is proven. If you cannot check most of these boxes honestly, a blind pool pitch to family offices is likely to generate a polite interest that never converts to a yes. And that's not a reflection of your project quality, it is a structure fit problem. The real underwriting test. Track record, reporting, pipeline, and control. When a family office evaluates whether to invest in your deal or your fund, they're really running a test across 4 variables. Each one answers a different question. Together, they determine whether your structure is credible or whether it's asking for more trust than you have earned. Here's how to score yourself honestly before outreach begins. Variable number 1, track record. Should the family office trust your judgment before seeing each deal? Low means 1 to 2 completed projects, limited exits, no institutional LPs. Medium means 3 to 5 completed projects, some exits. High net worth individual LP experience. High means 6+ projects, multiple realized exits, prior institutional LP relationships. Variable 2, reporting discipline. Will the investor know what's happening after closing, especially when things drift off plan? Low means ad hoc updates, no formal reporting cadence. Medium means quarterly reports, basic financials, reactive communication. High means institutional quarterly reports, proactive variance explanations, audited financials. Variable 3, pipeline repeatability. Does the blind pool have a real machine behind it or just a hopeful deal list? Low means 1 deal in mind, no documented sourcing process. Medium means 2 to 3 deals identified, some sourcing relationships. High means a documented sourcing engine, repeatable strategy, active pipeline with underwritten opportunities. Variable 4, control trade-off. Is the discretion you're asking for justified by your process and alignment? Low means asking for full discretion with limited track record. Medium means discretion on asset type with some constraints. High means full discretion backed by deep track record, institutional controls, and aligned fee structure. How to read your score. Mostly low. Deal by deal is the only credible structure right now. Focus on executing 1 or 2 strong projects, building the LP relationship, and earning the trust that a blind pool requires. Mix of low and medium deal by deal with programmatic JV framework. Offer the family office a deal by deal entry now with the option to formalize a broader relationship after the first project. Mostly medium, deal by deal is still the safer choice, but you can begin building the platform materials that a blind pool would require in 12 to 18 months. Now, mostly high, a blind pool is viable provided you have an anchor LP and a compelling fund thesis that answers the question, why should I commit to your fund when I can access your deals directly? The question family offices actually ask in 2026 is not what is the return, it's what happens if things don't go to plan, and how does the structure and the sponsor behave then? Your score on these 4 variables determines whether you have a credible answer. How to structure choice changes LP expectations in first meetings. The structure you bring to a family office changes the conversation from the first meeting. It determines what questions they ask, what materials they need to see, and what your data room has to prove. Developers who choose their structure before outreach show up prepared. Developers who try to explain structure gaps mid-process lose momentum. If you bring a deal-by-deal structure, expect asset-level questions first. What's the total cost basis and what does the per unit or per square foot basis look like relative to market? What's the downside case if construction costs run 15% over or the exit cap rate expands? How much are you co-investing in this deal? And what does your waterfall look like? What approval rights does the LP have on major decisions, refinancing, or sale? Why this market, this asset type, and this basis right now? If you bring a blind pool structure, expect platform-level questions first. How do you source deals? What's your first competitive advantage in finding assets that others miss? What are the fund's investment criteria and how do you enforce them when a deal is borderline? What does your reporting cadence look like and how do you communicate when a deal is underperforming? How deep is your team and who's accountable for execution if you're managing multiple assets simultaneously? What does your fee structure look like and how do you justify a management fee before performance is proven? The key takeaway here is practical. If you choose deal by deal, build your materials around the asset. If you choose blind pool, build your materials around the platform. Mismatching the two is one of the most common reasons a raise stalls after promising early conversations. A simple decision framework for seasoned developers raising $10 million. Before you start outreach, work through these questions in order. The answers will tell you which structure gives you the highest probability of closing. Step number 1. Do you have a specific asset or project to raise around? Yes? Start with deal by deal. You have something concrete for the investor to underwrite. No? Stop. Do not raise a blind pool on the promise of future deals. Find the asset first. Step 2. Have you completed 5 or more projects of the same type with documented realized returns? Yes? A blind pool may be viable. Continue to step 3. No? Deal by deal is the right structure for you. Use this raise to build the track record a blind pool requires. Step 3. Do you have institutional grade reporting, a documented sourcing process, and a team that can manage a fund? Yes? A blind pool is worth exploring. Continue to step 4. No. A deal by deal with a programmatic JV framework. Offer the LP a deal by deal entry now with a path to broader relationship. Step 4. Do you have at least one anchor LP who knows your work and is prepared to commit early? Yes. A blind pool raise is viable. Build the fund materials and begin targeted outreach. No, deal by deal first. Build the anchor relationship on a specific project, then revisit the fund thesis. Choosing the structure that fits your current maturity is not thinking small, it's protecting close probability. Do not bring a blind pool ask to a deal-by-deal market. Family office capital is available in 2026. The constraint is not capital, it's the structure under which capital gets released. 3 things to take away from this video. Number 1, deal by deal is the default structure for most family office targeted real estate raises right now. It asks for less blind trust, gives investors direct visibility into the asset, and matches how family offices actually want to deploy capital in this market. Number 2, blind pools still work, but only when the sponsor has already built the machine. A strong project pipeline is not a fund thesis. A reputable sourcing engine, institutional reporting, and a track record of realized exits is. Number 3, the structure you choose before outreach determines what questions get asked, what materials materials you need, and how long the process takes. Choosing the wrong one does not just slow you down, it signals to sophisticated LPs that you do not yet understand how they think. The right next step is to pressure test your structure before you start conversations, not after momentum stalls. If you want us to pressure test your structure before you start those conversations, we're going to have a link in the description below. IRC Partners works with seasoned developers to structure institutional grade capital raises between $5 million and $250 million and coordinate warm introductions to family offices actively deploying those capital or more in real estate LP equity. If you're preparing for a raise and want to confirm your structure before outreach begins, book a capital strategy session to get direct assessment. Frequently asked questions. What's the difference between a deal-by-deal structure and a blind pool in real estate? A deal-by-deal structure means investors review and approve each specific asset before committing capital. A blind pool means investors commit capital to a fund upfront and trust the GP to select future assets according to the fund's stated strategy. Deal-by-deal gives investors more control and visibility. Blind pools give the GP more speed and flexibility, but require a higher level of trust from the LP. Why do family offices prefer deal-by-deal structures in 2026? Family offices have shifted away from blind pool fund commitments after years of weaker fund performance, longer hold periods, and limited transparency. According to PwC's Global Family Office Deals Study in 2024, family office investments in funds declined by 9 percentage points since 2020, while club deals held steadily at 60% of investment volume. In 2026, family offices want asset-level visibility, governance rights, and direct relationships with sponsors before committing capital. Can a seasoned real estate developer raise a blind pool from family offices? Yes, but only if the developer has the track record, reporting system, and platform depth to justify asking for blind discretion. Family offices will want to see 5 or more completed projects with documented realized returns, institutional-grade quarterly reporting, a repeatable sourcing process, and ideally, a prior relationship with at least one anchor LP. Developers who try to raise a blind pool before building that foundation typically get polite interest that never converts. How much track record do I need to raise deal by deal from a family office? 3 to 5 completed projects with clear outcomes is generally enough to get meetings and build credibility in a deal-by-deal pitch. The investor is underwriting one specific asset, not your entire platform, so the bar is lower. What matters most is that you can show you've done this type of project before, that your returns were real, and that you've managed outside capital responsibly. What questions do family offices ask in a deal-by-deal first meeting? Expect asset-level questions, total cost basis, per unit or per square foot basis relative to market, downside scenarios, sponsor co-invest amount, LP approval rights on major decisions, and rationale for the specific market and asset type. Family offices in 2026 focus heavily on the downside case, not just the projected return. What's the biggest mistake developers make when choosing a raise structure? Bringing a blind pool pitch to a deal-by-deal market, many developers assume that having several deals in mind is enough to justify a fund. Family offices see it differently. A deal list is not a fund thesis. A repeatable sourcing engine, institutional controls, and a team that can manage a portfolio is. Mismatching the structure to your actual platform maturity is one of the most common reasons a raise stalls after promising early conversations. How does deal-by-deal structure affect waterfall and promote economics? Each deal-by-deal transaction is negotiated independently, which gives the GP more flexibility to adjust the waterfall, preferred return, and promote based on the specific asset, risk profile, and the LP relationship. A blind pool locks in fund-level economics across the assets for the fund's life. For developers still building LP relationships and refining their deal mix, the flexibility of deal-by-deal economics has real strategic value. Should I target a single-family office or a multi-family office for deal-by-deal raise? It depends on the check size you need and the level of decision-making speed required. Single-family offices often have more flexibility on structure and typically can move faster but require a more personal relationship. Multi-family offices have more formalized processes but broader LP networks. What is a programmatic JV, and is it a middle ground between deal-by-deal and a blind pool? Yes, a programmatic JV is an agreement where the LP commits to a framework for participating in future deals that meet defined criteria without committing capital to a blind pool up front. It gives the GP more predictability than pure deal by deal and gives LP more control than a fund. It's a useful middle path for developers who have a strong existing LP relationship and a repeatable deal strategy, but are not yet ready for a full fund raise. How do I know if my raise is better suited to a family office or a private equity fund? The structure question and the LP type question are related but separate. Family offices are generally more flexible on structure, more interested in direct deal economics, and more focused on long-term relationships. Private equity funds have more standardized processes, faster decision timelines, and typically larger check sizes.